Let's start off with what the Fed is thinking about going into the year 2024. So, as we know, inflation is slowing. Our last CPI report from October came in at 3.2% overhead, which means that inflation is coming down and the United States is entering disinflation. Not deflation, disinflation, which means our inflation rate is going down. Now, what does this mean for the Fed? Well, Wall Street firms are expecting that interest rates will be cut sometime into the next year. Markets broadly anticipate a 1% decline in the federal funds rate from 4% from the current 5%, down to 4% from the current 5% by the end of 2024. Now, the argument here is whether this begins in the summer of 2024 or in the spring. Interest rates take a long time to have an effect, but if the Fed makes the decision to start cutting rates in the spring, that could have massive consequences for the 2024 presidential election, which I think is really interesting.
Yeah, it's very important. I have seen some people expecting that the cuts might happen earlier in 2024 rather than later, but it's mixed across the board. There's not really a consensus.
Yeah, Biden is basically begging that the Fed decides to cut the rates earlier in 2024 than later, right? Biden is having a terrible approval rating, as we'll talk about later in the show, for a bunch of different reasons. And people just do not feel like the economy is doing well, mainly because asset prices in the stock market just haven't had the same amount of growth that you had under Trump. It's just the truth. If the federal funds rate starts being cut, we can expect to see asset prices start raising fairly quickly in the stock market, which might be able to give people an idea, see their 401k grow, and they're like, okay, maybe the economy's actually doing pretty okay.
Yeah, and I feel like the big buyers that drive the economy, like the big institutions, care a lot about interest rates and what they see what the Fed thinks about the economy, and it reflects how much they spend and invest, and that's what drives markets. So if they're able to see the Fed becomes a little bit more confident in the soft landing sticking, then I feel like those institutions might buy in more, drive the economy up.
Absolutely. We always talk about how so much of the economy is just a perception game.
Yeah.
Right? It's just a perception game. And if the Fed is ready to perceive and show confidence, everyone else is going to follow suit.
Yep.
Now, the sticking point for Biden's economy here has always been inflation. That has been the number one issue of this economy over the last 2 years here. And voters expect prices to come down, which makes Biden's position very, very difficult and makes Janet Yellen, the Treasury Secretary's position, very, very difficult. Deflation is not good for an economy. Prices going down is not a sign of a healthy economy. It means that wages are overall going to have to decrease to accommodate the now lower profit margins. It's also going to mean that there is less demand for products and the less consumption going on because there's no shortness of supply at all. There's an overabundance of supply, which could hurt investments of these companies, right? They don't want to keep investing into products and keep growing the economy. But we do see some deflation possible in two of our most volatile sectors. The CEO of Walmart has suggested that grocery prices will start falling over the next year, specifically citing the tight pocketbooks of the American consumer because their mortgage rates are going up, their car rates are going up, their insurance rates are going up, all because of interest rate hikes that are now hurting their spending power.
Student loan payments are also resumed, and that means there's a big monthly chunk that's coming out of people's pocketbooks.
Exactly. And so now crude oil has fallen 20% since September, and we will expect to see crude oil kind of staying near that low, save for any geopolitical shocks that very too frequently happen. So, what do you think?
I feel like this is kind of good. Like, I think very targeted, very specific deflation in these volatile places. One, it's going to reflect really well on Biden because we actually just talked about last week, I think, how when people are polled on the economy and how they feel about it, it is the price of gas at the pump and the price of their food that drive their sentiments the most, right? So this is going to be helpful for that. Meanwhile, I think this deflation can stay very contained. I think the other types of production services that are done here can still grow while prices here fall.
No,
so you can kind of have our cake and eat it too.
No, I totally agree. And we talk all the time when we read the CPI reports. There is headline CPI and then core CPI. And the Federal Reserve takes into account core CPI, not headline. And, core CPI cuts out oil and it cuts out food because of how volatile those commodities are. So seeing a deflationary year in those markets might not be a sign of overall economic slowdown, which that's going to be, that's the two sides of the coin here. You can have deflation and prices go down, but that's going to hurt economic growth, right?
Sure.
That's the line. But if it's only contained to these specific volatile commodities anyway, I don't know if it will necessarily lead to economic slowdown.
I don't either, because I think it will free up people's money to be spent on other things.
Right, exactly. And we have to take into account also that the federal government is still pumping a lot of money into very hard manufacturing industries, right?
Yes.
With the semiconductor industry, there's a lot of money going to infrastructure over the next decade and stuff. So there's money being spent in other areas that I think will actually more meaningfully grow the economy than Walmart's profit margin.
Yes, I absolutely agree. It's gonna drive consumption and demand more in those areas. And I also think it's important to discuss really quickly why these areas are able to deflate. Oil is one thing, right, where it is mostly just dependent on external foreign factors. But food, it's important because food has inflated a lot over the past year or two because of supply chain issues that have come in. And those are starting to kind of smooth out, so we don't have to worry about those price shocks as much. It's a structural thing that is changing, so it makes sense that the prices will come down because the prices of Walmart and retailers, right, they can come down and still have those profit margins if the initial supplier prices are down. So I feel like that means it's stickier and it's less likely to ripple throughout the economy.
Yeah, I agree. Now let's get to one of the biggest geopolitical Okay.
Wow.
That was a really bad refocus.
Yeah.
I wonder if we could lock the focus on the camera. Maybe when I get up, I'll
That'd
see
be
if I can do
interesting.
that.